Hey everyone, and welcome back to the channel. So today we are in the StockSpot office and we have a special guest, and this is Chris from StockSpot, and he is the founder and CEO of StockSpot. But before he was the founder and CEO of StockSpot, he actually used to work as a day trader and then turned into more of a long-term investor. So he has been investing for 23 years and actually started really young when he was just 11. So over these 23 years, he's built up a lot of knowledge about investing and how to make good investment decisions. So I thought it would be awesome to have him on the channel and share some of his experience with us and give us some information on how we can make better investments as investors. So welcome, Chris.
Thanks, Quinn. Yeah, 23 years makes me feel very old.
Well, he started really young, so.
That's true, yeah, but yeah, makes me feel like it was a long time ago.
Yeah. So I wanted to kick it off with just how you actually got started with investing and what was that process between, I guess, being a day trader and then turning into more of a long-term investor. Like, what has your journey been so far?
Sure, well, yeah, it's a long story that starts back in the late 90s. So the world was obviously a very different place then. There wasn't the internet, well, it was in the early days, and so getting information about investing wasn't as easy. My dad actually sat me down and said, Chris, here's $1,000. Go and read the newspaper and find a share that you want to invest in, and you can invest this $1,000 and learn about that company. So, you know, like you, I wanted to invest in companies that I felt like I understood and liked, and so I was reading the newspaper, and companies like Woolworths existed then. Actually, my brother, who had the same opportunity, invested in Woolworths, but I always liked gemstones as a kid, so I picked a company called Ashton Diamonds, which was a diamond mining company, and invested $1,000 in that company. And yeah, that was my first sort of foray into investing. Every day after school then I would, and you couldn't just sort of log in to find the price, I would actually get a stockbroker to fax me, if you can believe that. If anyone even knows what a fax is these days, all of the share prices of all of the different companies I was following on my watch list. And I would look at the different prices, I would read the newspaper, I'd be reading magazines and different books to try and work out what I should be buying or selling. So yeah, that was the kind of very early days. You know, in the late 90s, similar to today, there was a bit of a tech boom evolving. So after I originally bought a few mining shares, I realized that mining wasn't really taking off and the companies weren't doing very well. So I switched my strategy to start to buy tech shares. Now this was sort of the internet 1.0, so there were very different types of tech shares. Most of them actually don't still exist, especially the ones that were listed in Australia, but there was a lot of hype. You know, these companies were going up 100, 200, 1,000% very quickly. There was a few internet forums sort of starting to discuss them, so I was getting involved as like a 11 and 12-year-old kid on all of these internet forums, chatting about these stocks. Initially, you know, I did really well. I mean, I felt like a genius. I was making profit year after year. I turned, you know, $1,000 or, you know, a very small amount of money, you know, I think somewhere between $15,000 and $20,000, which for a really young kid is a ton of money. But then just as quickly, when the tech boom bust in 2000, I lost most of that. So I bet probably too much of my money on these tech stocks, believing all of the stories they were telling, and then the world changed and all of these companies fell by 80 or 90%. So then the real sort of learning started, I think, when I realized I wasn't as smart as I thought I was. And then, yeah, I mean, I've been sort of dedicated to it ever since. Throughout high school, I was, you know, spending a lot of time learning about the share market. I entered the ASX share market trading competition a few times, and I was lucky enough as a kid to win it a few times as well.
Oh my gosh, that's amazing.
So yeah, I was lucky. That gave me the opportunity to do work experience at the ASX. So as a year 8 or 9 student, I went to the ASX and did work experience. I then got to actually trade for a hedge fund while I was at university. So actually doing professional trading, and that got me my first graduate job, which was as a professional trader at UBS. So yeah, really from when I was like 11 or 12 through to my mid-20s, I was kind of learning more and more about, you know, what I later realized to be trading, you know, how to make money out of sort of short-term market moves and how to read markets, you know, read other sort of technical signals in markets to work out how to lock in sort of short-term profit. And then, you know, I left that world about 7 or 8 years ago to start StockSpot, which actually has a very different investing philosophy. We're all about investing for the very long run. really trying to ignore all of the short-term fads, park them all to one side, let everyone else play with those, and try and figure out a sensible sort of strategy that will make consistent profits over the long run. And I think that was really because of what I learned in the early days, that a lot of newbies in the market, really are taking a lot of risk if they're kind of gambling like I was as a kid. And so if they want to really be developing their wealth, there should be an easy alternative that's a more long-term, stable investment.
Yeah, I completely agree with that. And I think that, even though it's a very painful lesson to lose a lot of money, the lesson is more valuable, I think, than the money that you lost at the end of the day, because I'm sure that you've made your money back multiple times. I think we all need to sometimes have those painful losses to make us realize and take a step back. So I wanted to know, why did you switch from more that day trader to starting a business that was more focused on long-term investing?
Well, a few reasons. So first of all, when I was a professional trader, I learned a lot about that sort of world and also how hard it is to consistently do well, as a trader. I think trading's probably become a lot more competitive even since when I was starting in the 90s. These days, there are thousands and thousands of people around the world, on their computers, trading. And it's actually really hard to win in that sort of market because there are so many smart people participating. Most of the strategies that actually can make you money consistently aren't even available to most kind of at-home traders. So all of the strategies I ran, for instance, at a hedge fund or at UBS, required me to be able to short shares. So not only have a positive view on companies, but also a negative view, and sort of lock in the profit between the two. And most people don't actually do that if they're trading at home. So it's really difficult to compete with these professionals. So I realized a lot of people were probably trying to be professionals when really there was a better way that they could probably earn similar returns, but actually do a lot less. And a lot of my friends around the same time would come to me and say, Chris, I know you work in this sort of world. I've got all this money parked in an ING savings account earning 2%. It's probably a lot less now, but back then it was 2 or 3%. I've heard about the share market and I've heard you can do better. What should I invest in? And for all of these friends, I definitely wouldn't be saying, you should be coming up with a sophisticated trading strategy. Set up an account that allows you to buy some low-cost index funds. Whenever you have some extra savings from your salary or, from somewhere else, just keep on putting it into these index funds, because over the long run, that's going to give you a phenomenal return. It's going to kind of create this discipline and this habit of doing it regularly, which is going to allow you to enjoy the benefit of compounding that you always talk about as well. And actually, it means you won't need to pay any attention to it really, and you can get on with doing, whatever you do in your life while your money's working, hard for you. So that was always the advice I'd give to my friends, but I never really saw any easy ways for them to do it. So, at the start, I'd sort of help them set up brokerage accounts, but then, there was a challenge of making sure that they had the right ETFs in their portfolios, that they were mixed in the right way based on the time horizon of how long they were wanting to invest for, that they were rebalanced whenever markets were really moving in a wild way, and then also tax and stuff is pretty complex. So I'd be telling my friends to do this, and then they'd give me all these really complex tax statements at the end of the year and say, Chris, what do I make of all of this? I don't have an accountant, please help me. So, after doing that for a few years, I realized, well, wait a second, there's probably a business opportunity here to help people like all of, my friends in their 20s and 30s who are smart enough to know that leaving your money in the bank is a pretty dumb thing to do long run, because you're not going to make a great return. So they know they shouldn't be doing that, but they're just not confident enough to invest in the share market because they don't know how to do it. And that was really the inspiration for setting up the business.
That's amazing. That's so true. And I think I love how you mentioned that, I guess, day trading and getting those phenomenal returns that we hear about. It's hard to do consistently. Even Warren Buffett, the most renowned investor, I think his average return is about 20% per year, which is amazing, but it's nowhere near the 200, 300% we hear about from some of those crazy stocks. So
no, it shows you don't need a huge percentage return, you just need consistency. So, it's really tempting to try and make 100 or 200% returns. The problem is if the next year you make minus 50%, you're back to where you started.
Exactly.
And I remember that happened to me when I was young. Buffett's also a great example because he started his career when markets weren't very competitive and there weren't many professional traders. And so most of his returns were made in the 70s and 80s and early 90s. But actually for the last 15 years or so, he hasn't even beaten an index fund. and it's not really discussed that often that actually professional investing is getting so much harder that even the smartest bloke in the world can't beat the market. And that's why he even says to all of his followers, like, just invest in index funds. Do not give your money to active managers. And, you really don't need to try and pick companies like I do. There's so many people doing that, you're probably not going to beat them.
Yeah, exactly. Completely agree with everything that you've just said. So over your years of experience in investing and trading and just learning about the whole space, what are the 3 biggest things that you've learned?
Yeah, a lot of lessons in 23 years. The first one, which I kind of touched on earlier, which is that, there's a temptation, I think, when you're getting started investing to keep on kind of increasing your bet sizes. You might have a little win here or there, and then you think, well, this is easy. I'm not going to just invest a couple of $1,000s. I'm going to, put a lot more in, or I'm going to get a margin loan, or I'm going to take some equity out of my house. And I would say, look, that's probably not the right decision. Starting small, is a good idea, and actually, it's actually quite risky sort of ramping up your trading as you have wins, because at some point your wins may unwind, and it could hurt you quite a lot. So my tip would always be the opposite. I know you've talked about this in some of your other videos, that if you do make a bit of profit, it might make sense to sell some down and actually lock in that profit to put it into something safer. You made the decision to put it into a house. I think that's really sensible. I wish as a 13 or 12-year-old kid, I had the foresight to actually sell down some of my tech shares and just put it into a safer, I don't think ETFs existed back then, but a managed fund or something, where I would have earned 10% a year for 23 years as opposed to losing it all. In terms of other tips, I think like one of the other ones is that, as a newbie investor, you think you kind of need to do a lot of different things to be successful. It's very counterintuitive, but actually with investing, if you do a lot of things and are very active in buying and selling, you actually might harm your returns, because there's brokerage, there's probably the temptation to buy when you shouldn't be buying, like after everyone else has bought. And so actually having the discipline to do less, is one of the things I've learned. It's probably one of the things that separates the great investors like Buffett from others, is that he's happy to just hold on to a company for decades and decades and not do anything. And so while others are chopping and changing and buying and selling, he's just holding and holding. And so, really fighting that inner sort of voice that's saying, Queenie, you should be buying, you should be selling, you should be buying, you should be selling. You got to fight that voice and just say, no, like, I've set my strategy, I'm going to stick to it. And sticking with it, I think, is really important and will set you up in good stead. And yeah, the third, I think is kind of really around kind of costs. Like, I think again, a lot of other areas in our life, you kind of think that if you pay more, you're going to get something better. But with investing, like I see it so often, people kind of pay more, whether it's to an advisor or a fund manager or in brokerage, and actually it's the worst thing you can do, because like every dollar you spend when you're investing is money that has to come out of your returns. And so really when it comes to investing, you should be trying to keep your costs quite low, because that's going to actually make your return bigger, not smaller.
Completely agree with all of those points. Those are some really good tips. I think fighting that urge to just keep going is really hard. Sometimes you just have to be patient and just wait and just have faith in yourself and the investments and the research that you've done. And to wrap up this interview, are there any final thoughts that you'd like to share with the audience just about investing, how to make better investments?
Well, I think it probably goes back to the lessons I've learnt. So with investing, a lot of people that get started want it to be an exciting thing. It does kind of give you the adrenaline, when you see your shares going up. And I think that's absolutely fine for part of your portfolio to give you that adrenaline, to, allow you to learn and develop and discover companies and, be involved in things that are changing the world. But yeah, really separating that from the part of your portfolio that really should be boring. If you're saving up for a house or a holiday or your retirement, that part of your portfolio doesn't need to be like high octane, really exciting stuff. It can be the boring stuff, the stuff that, will give you a 5 or 10% a year return, but, won't give you the minus 50% a year. If your investments are boring, that's actually not a bad thing. Investing, really, if it's long-term investing, should be like watching grass grow, where it doesn't excite you, it doesn't get your heart thumping. And if you're investing in that way, like, you're probably going to be a successful investor.
That is such a good quote. Can we just plaster that on the wall somewhere? Like, it's I need this somewhere.
Well, yeah, I mean, if you're logging in every day, and this is what I try and explain to our clients is like logging in every day to your account actually isn't healthy because like it's going to make you want to buy and sell. And there's some great studies that were done in the US where actually they showed that the people that had the best returns on brokerage accounts were the ones that either lost their passwords or died.
Oh my God.
And you know, it's that's a bit morbid, but actually, you know, if you can learn something from that is the people that aren't logging in either because they can't or for one way or another, and they're the ones that are doing the best, then, you know, try and learn from those guys.
Try and learn from them. Lose your password. Thank you so much for coming on the channel and for sharing your experience and your knowledge. I've certainly learned a lot and completely agree with everything that you've said. And I also did want to note for our viewers that StockSpot was actually my first investment. And while I was investing in speculative cryptocurrency, thankfully, I was also investing in StockSpot at the same time. So while I lost a lot of money in crypto, pretty much most of the money I put in there, even though I started pretty early in cryptocurrency, I still lost quite a bit of money. My investments in StockSpot have been very, very consistent year on year, and it was such a good first investment for me to make. And knowing that, hearing what Chris has said, completely agree. Sometimes boring investments are the best ones to make. So if you'd like to learn more about StockSpot, I've also put a link down in the description below so you can check it out. And yeah, I really think that it is a great company and Chris is doing an amazing job. So thank you for watching, and I'll see you guys in the next video. See ya.